Good morning, everyone. Prince, we're good to go.
Good morning, everyone, and welcome to today's session. We are glad you are joining, and we are also glad and we appreciate you taking time out of your busy schedule. You know, it's a busy week, today also being Thursday. We appreciate you taking time out of your busy schedule to join our session today. The subject matter that will be under discussion this morning during this our 60-minute discussion is we are going to be looking at Ghana's economic outlook amid uncertainties in the Middle East. So when we look at recent developments in the Middle East, it has once again brought into sharp focus geopolitical risks and its attendant impact on the wider Middle East region, and even extending to those of us in Sub-Saharan Africa. During today's discussion, we will be attempting to look at how these developments impact specifically the Ghanaian economy, and then we'll also look at what we can do to hedge. Today's session we'll have two different sections of talks. I'll be taking the second session, and then my senior colleague, Mr. 𝗘𝗰𝘁 will be taking the first session. Before I will introduce the first speaker, we would like to take a poll to set the tone for the discussion. The poll should just be coming up onto your screens now. Please look through and then choose the option that best fits in your opinion. So just to read out the question says, which area of Ghana's economy is most vulnerable to a prolonged Middle East conflict? So please give your answers to the poll. We can do this in about some 30 seconds. Thank you. You can see the answers coming up now. We still have some time. If you have not yet filled the poll, please do that. Okay. Thank you so much. We still have some 10 seconds. Please do well to give your answers to the poll to have that form of interaction. All right. Thank you so much. Thank you. We can do some final 5 seconds before we close out on the poll. All right. Thank you so much. So we would like to end the poll over here. And the discussions or the results will be shared subsequently after we have completed the discussions. I would now like to introduce our first speaker for the day, who is an associate director with Agusto & Co. and also our head of consulting, in the person of Mr. 𝗘𝗰𝘁. As I mentioned earlier, Mr. 𝗘𝗰 will be taking the first session, and myself, Prince, I'll be taking I'll be taking the second session. So please sit back and enjoy the first session. Mr. 𝗘𝗰, please, over to you. Thank you.
Thank you very much, Prince. Good day to everyone. Thanks for joining us on this session. We really do appreciate your presence, and we'll be making the recording and the documents accessible to all of you after this. We'll be looking at how, as Prince has our reading of Ghana's economic outlook, particularly tracing it to the uncertainties in the Middle East. Prince, let's share what the document outline will look like today. So we'll just give a quick background on the context of the Middle East crisis, and then we would look at the oil markets. And so I'll take the first half, which is looking at the background and context of the Middle East crisis, the oil markets. Prince will be looking at the implications of the crisis on the Ghanaian economy and what Ghana can do to hedge. So in terms of the crisis, how we got here, and if we could just look at the next slide. So we all know that a bit of news update here. On February 20th this year, And especially because if you look at where the world is coming from today, in 2000, we had the global pandemic. And just as we were recovering from the global pandemic, we had the Russia-Ukraine crisis 2 years afterwards. And then when we were fully in recovery mode, not because the Russia-Ukraine crisis had all of its impact had abated, but because the world had adjusted to its impact, Ghana had largely moved on. And then 4 years after, just around the same time, 4 years after the Russia-Ukraine crisis, the US and Israel go to war, launch joint strikes on Iran. 3 target locations were hit in half a minute. In retaliation, Iran closed the Strait of Hormuz, triggering a global energy shock. And that's what we're here to talk about today. So America called it Operation Epic Fury. And still on the slide for a second. America called it Operation Epic Fury. For the first time in a long time, Iran exercised its, I won't call it rights, but I'll call it Iran exercised its powers over the Hormuz. And that's why we're here. Now, where are we today on all of these? There's been a ceasefire. It was supposed to be a 2-week ceasefire. Good for all of us. It lasted well beyond the 2 weeks. But right now, we're at that phase where the drums of war, like a poet once called it, the rhetorics seem to be building up towards another open escalation once again. So, notwithstanding the fact that all of the effects, all of the impact, especially around oil, we haven't even resolved all of that, but it's only going to get worse if the troubles escalate all over again. We can proceed, Prince. So now, why are we even talking about Iran anyway? What's its strategic position? Why is it so important? Iran leads what is known in diplomatic circles and global politics as the axis of resistance, which is largely its influence within some Middle East states, in Gaza, Palestine, in Lebanon with a government outside of a government known as Hezbollah, in Syria where it held sway before the Assad regime collapsed, in Iraq where it is allied with the Shia militia, in Yemen with the Houthis, and then even here in Africa, close to home, in Sudan with the army. So in all of these countries and with all of these groups, Iran is able to exercise some level of influence and authority on all of these groups. And some of these groups play strategic roles in the axis of resistance, like the Houthis in Yemen. Okay? Then, let's start bringing this home gradually and looking at oil. Iran's crude oil production levels. So if we look around in 2020, around the COVID period, Iran was producing less than 2 million barrels per day. But it has gradually climbed up all the way to over 3 million barrels per day. And it's very important, for instance, to the likes of China. And we know what China's role is in the world's economy. So globally, where the US, Russia, and Saudi, the trio which dominate global oil production and all do and have the capabilities to do above 10 million barrels per day. So outside the 10 million plus club, you now begin to have the likes of Iraq, and then Canada, the UAE, and then Iran. Because Iran is in the 3 million club, and that can easily rise. But it's one country that has had a troubled past, a troubled history, and a troubled present, actually, which has largely distorted its crude oil production. Next slide. So let's then talk about the Strait of Hormuz. And I'm sure you've all been inundated with news around the Strait of Hormuz, its importance in numbers. And we'll just drop a few of those numbers you heard before. 20% of the world's crude oil production is transported through the Strait of Hormuz. So that's where the Strait of Hormuz becomes very important. It's just 33 kilometers wide at its narrowest point. However, this 33-kilometer wide strait helps with the transportation of 20% of the world's crude oil production. But beyond even crude oil production, a third of fertilizer exports globally passes through the strait. 46% of urea, the world's most widely used nitrogen fertilizer, also passes through the strait. On average, 138 ships transporting strategic commodities for the world pass through the Strait of Hormuz. On average, daily, 138 ships. But from the start of the conflict all the way to March 7th, only one single commercial vessel passed. In mid-May, the average has come to about 60 per day. But if you look at the 138 to 60, you would see that the strait hasn't bounced to its peak period, or its 130 plus peak. So we're still less than half. And that less than half, amidst all of these transport infrastructure alternatives for crude oil and gas, we're still suffering the impact in terms of oil prices on the strait. But while the strait can take care, and I'm calling the Strait of Hormuz the strait of conversation, and while the strait can take care, we can find alternatives to the Strait of Hormuz, especially with pipelines for crude oil production and gas production. Are we going to pass fertilizer and urea through pipelines as well? Well, we dare say no. Next slide. In terms of shipments across the strait, we've already talked about the oil cargo tonnage, and in terms of fertilizer tonnage, 1 million. And we told you earlier that a third of fertilizer and 46% of urea. But what does this represent in absolute numbers? More than 1 million metric tons of fertilizer cargo. At some point before this release that we're seeing in mid-May of about 60 ships, at the peak of the crisis, 1 million tons of fertilizer were physically stranded in the Gulf. 1 million tons. So picture that, at 1 million tons of fertilizer physically stranded through the Gulf. Next slide. Now, where are we with the strait? The US and the negotiations represent lots of moving parts. The US, following the presidency, the rhetorics of the US president, on one hand, the US president has said he'll be open to managing the strait along with Iran. But if you follow the trajectory of the current US administration, you would see that there seems to be a fascination with either straits or even canals. And let's not deviate to Panama, and let's remain the argument within the Middle East. But it just shows a pattern where they are interested in straits or in vessel passages along all of these narrow but symbolically and strategically important waterways for seafaring vessels. Now, the US has said we can jointly manage. No, still on the slide. The US has said we can jointly manage. Iran has rejected that. Iran has used this fast craft boats to attack a few vessels. There was news of Iran attacking a US naval vessel. The US placed on April 12th on the Strait of Hormuz. But there's something very important that we all need to take away from this, and two things actually. China also depends on the Strait of Hormuz for 38% of course, 38% of all Hormuz's crude flows goes to China, more than any other nation. However, you need to appreciate that what affects China affects the rest of the world, Ghana inclusive, because China is the world's production and manufacturing factory today. On the other hand, President Xi and President Trump meeting right about this week in Beijing. We don't know what's going to come out of that. So China's economy needs to be healthy. for the rest of the world. We need to take that away. Now, secondly, very importantly, insurance risks. In all of these, we need to appreciate what happens to insurance risks, measuring what Lloyd's Joint War Committee has said. War premiums surged for seafaring vessels passing through the strait to 60 times pre-crisis rates within 48 hours. So at the end of the day, how the insurance space measures risks in the strait would matter. And that's one key takeaway, that even when all of the military crisis has sort of subsided, abated, and piped low and cooled off, the insurance, we need to monitor insurance risks and insurance premium, because that will tell on the cost of goods that pass through the strait. And cost of goods, because if less goods pass through the strait, it means they are going to be taking more expensive routes, which will tell on consumers in Ghana. So let's look at the oil markets now. We've already explained why the strait is important to oil, because 20% of the world's crude oil passes through passes through the strait. And at the start of the year, and let's show you how that affects the oil market. At the start of the year, one of the world's global banks, JP Morgan, had a forecast for Brent averaging $60 per barrel for 2026. And even for Ghana, Agusto Consulting had built its forecast in terms of scenarios for Ghana around oil between $60 to $75 per barrel, because Ghana is also a crude oil exporting country. But we'll see how totally irrelevant all of these forecasts are today when oil, shot above $100 per barrel. And we can begin to look at even the prices on some of the maps and some of the charts we've shown. Okay, so look at the oil price volatility in terms of historical data. So you would see how crisis equals price volatility for the strait. How Russia-Ukraine crisis took oil. The last time oil went well above $100 per barrel was the Russia-Ukraine war. In COVID, we saw the opposite because of the lockdowns, which cramped movement, and movement means oil consumption. And as the crisis commenced as well, we saw oil rise from $60, $70 per barrel levels, all beyond $100 per barrel. Now, on one hand, even though Ghana is an oil exporting country, but remember that Ghana is also an oil importing country, and without local refining capacity, it means that we have to, even whatever we earn from the export of crude oil at a high rate, it tells on us when we begin to import refined petroleum for local consumption. Next slide. Okay, post-war pricing, we'll continue to see all of these volatilities in oil pricing. Sadly, there's a bit of, there have been news around insider trading, which is really hard to map in all of these volatilities that we have seen in oil prices. But let's keep it to the simple minds, really. And as long as the rhetorics continue, what these rhetorics will do is that it would continue to spike and introduce volatilities, which economies do not like. Economic players at the policy level, at the corporate level, these volatilities we are seeing in this chart using Brent, post-war pricing of Brent as a benchmark is quite unhealthy to the economy of Ghana and to economic and to corporate entities in the country as well, and to consumers as well. So we'll bring all of these global effects, all of these global impacts, especially from the Middle East, we're now bringing it home to Ghana. What is the implication or the implications of all of these on the Ghanaian economy? What are the downsides? Where are the upsides? And how can Ghana hedge? Prince, bring it on. Thank you very much for listening. So I'll be on standby to take questions as well. Prince.
All right. Thank you, Mr. Jimmy, for that insightful presentation. So just as Jimmy rightly mentioned, in this session, we'll be bringing the conversation home to Ghana and then looking at what are the implications of the crisis on our Ghanaian economy. This session is subdivided into two. The first is we'll be looking at only two major channels of impact of the crisis. Afterwards, the next part of this presentation, we will also be looking at what Ghana can do to hedge some of the impact of this crisis. The first channel of impact, that of course is very natural, is energy prices and the whole energy story. So why should we look at oil prices or energy as one of our sources of concern? It is instructive to note that approximately 97% of refined petroleum products in Ghana are imported, and also fuel imports and its associated products account for about 30% of our total import bill. What does this mean? It means that any slight change, increase in fuel prices, hydrocarbon prices, has a very important impact on the Ghanaian economy. And recently, following the happenings with the war starting somewhere around end of February, early March, we saw increases in fuel prices, with fuel prices increasing from somewhere around 12 cedis, that is prices at the pump, going up. And because of this, on 15th of April 2026, the government announced a 1-month temporary fuel subsidy, which is a 2 cedis subsidy on diesel and then 36 pesos on petrol. For this, we estimate that this will cost the government, for the 1 month, this will cost the government about 478 million cedis, or if you like, 3% of tax revenue for 1 month. And with this calculation, we are looking at tax revenues for 2025 as our base of calculation or assumption. So we see this chart talks about the increases in fuel prices. When we follow carefully, somewhere around 1st March, where the prices started, you can see where diesel and then petrol prices were, with petrol prices being in the blue line and then diesel prices being the red line. And then as at mid-April, we saw that, or we can see on the chart, that diesel prices had moved to somewhere 16 cedis from 12 cedis, which marks about 30% increase in prices. And then we can also see that petrol prices also have done about a 20% increase. Now, what are the impact of all this on our economy? Looking at some macro indicators of interest, such as inflation. For the past 15 months or so, Ghana has had the good news of having a disinflationary trend, with inflation moving all the way down to the lower bandwidth of Bank of Ghana. And we had inflation as at March 2026. Inflation has had decreased all the way to 3.2%. But in April 2026, which was last month, we saw that inflation once again had an uptick up to 3.4%. Looking at this, what is our outlook for inflation for the next 3 to 6 months or 12 months, if you would like? For this, we anticipate an upward trend in inflation, underpinned by expected higher fertilizer prices and the impact of rising fuel costs. Indeed, when Jimmy was having his side of the presentation, he mentioned how the dynamics affects fertilizer prices. And we've also heard the World Bank mention that we expect fertilizer prices to increase as much as 30% in 2026 before we will have some form of price normalization in 2027. And we all know how important fertilizer is to crop production and, of course, food inflation. Based on this, we anticipate that once fertilizer prices increase, this will have some form of impact on inflation and also rising fuel costs. However, we think that in the short term, the impact of these fuel costs will be partly mitigated by the 1 month subsidy that the government put in place, which should expire somewhere mid of May or end of May, depending on when it was started. And closely related to this is its impact on interest rates or Bank of Ghana's rates. We expect the Bank of Ghana to pause the easing cycle as it adopts a cautionary posture against rising domestic costs and elevated hydrocarbon prices. Of course, already we've seen inflation starting to have an uptick. This means that, of course, the Bank of Ghana will try to pause its easing cycle, probably hold to see how it can effectively anchor some of these risks. Now we will look at the second channel of impact, which is also of concern. So the other one we'll be looking at is gold. Why should we be looking at gold as a source of concern? So to build some form of context, gold currently accounts for about 65% of Ghana's total export, which is about 2/3 of everything that Ghana exports is gold. Also, gold accounts for about 15% of Bank of Ghana's total asset base. And when we also look at data, about 72% of Ghana's ASM-linked gold, where ASM is artisanal and small-scale mining gold, is exported to the Middle East, specifically Dubai. So even with this alone, we can see how exposed Ghana's export channel is to the Middle East, and of course, its attendant impact based on the crisis that is being had over there. And because of how large the export market is, we see gold as a key FX anchor and a major support to overall macroeconomic stability. So this goes to say that it is one of the major sources that prices can impact our Ghanaian economy, can impact our fortune. If you want to talk about exchange rates, if you want to talk about macroeconomic stability, one of the major factors that we cannot talk without is gold. What is our outlook for prices? So when you look at the chart on my left, you could see that since the beginning of 2025, gold has been on an upward trend. Some analysts thought in 2025 had peaked at an all-time high. But I mean, in 2026, you could still see in the early parts of the year, gold prices increased and even reached a point of $5,300 per troy ounce as at early February. However, we begin to see signs of price correction. When you look at the tail end of the chart, you could see that as at early May, gold prices had softened to somewhere $4,700 per troy ounce. And we believe this reflects sensitivity to US monetary policy expectations and also profit-taking activity by traders. What is Agusto and Co.'s outlook on gold prices? Notwithstanding the normalization, the price normalization that we are seeing, we expect gold prices to average somewhere around $4,500 per troy ounce in 2026. And just to give some form of context, even though we saw higher prices in 2025, you could see that about 20% of those higher prices were in the late part of the year. So gold prices averaged somewhere around $3,600 per troy ounce in 2025. And then looking at prices now, we expect that at least we should have some form of average around $4,500 per troy ounce. And what informs our expectation or our outlook? Of course, we continue to see structural demand support. And when I say structural demand support, what do I mean? What is driving gold prices, if one may ask? The factors are simple. We have central bank gold purchases and then the general geopolitical tensions, especially in the Middle East. And this is not something that just started in 2026, in 2025, even coming from 2024, there has been a lot of tensions and crises here and there. We could talk about the Israel-Hamas war that started earlier in 2025. We could also talk about Trump's tariff. That was the talk of town in early 2025. So there has been a lot of tension, which also introduces uncertainties. And gold prices tend to do well during times of uncertainties. So even though we see some form of price normalization, we do not see this to persist for a very long time. We believe that prices will average somewhere $4,500 per troy ounce in 2026, supported by structural demand. So now let's look at summary of the downside risk. One thing that we would like to take away from the whole of the presentation for today is what are the key risks that the Middle East conflicts or crisis is likely to have on the Ghanaian economy. The first one that I would like to start with, and of course your guess is as good as mine, is energy prices. So just as I mentioned earlier in the presentation, we've seen petrol and diesel prices go up by 20% and 30% respectively since beginning of the war, somewhere early March 2026. And of course, we expect this to prop up inflation in the near term, reflecting broad-based pass-throughs from higher energy costs on the economy. And we know that this has its own transmission channels, and one of them is transport logistics. The surge in petrol and diesel prices has a direct impact, just as I mentioned, on transport and logistics costs. However, we think the temporary fuel subsidy has largely absorbed this as transport prices are yet to increase. Those of us who use the public transport, the Uber, so on and so forth, we will see that there hasn't been a major increase in prices yet, largely due to the temporary fuel subsidy that we've had. However, we think that the GPRTU, which is the Ghana Private Road Transport Union, is likely to increase first if the subsidy is not extended and higher fuel prices persist. I can see a hand up. We'll be taking Q&A session after the end of the presentation. So please, you can hang on with your questions. Once it is Q&A session, your questions will be attended to. The final source of key risk that we are also looking at, or we also intend to track, is food security. Just as we mentioned over the course of the presentation, fertilizer prices are expected to increase by about 30%. And of course, this is expected to have an impact on cost of food production in the near term. And this is particularly instructive as Ghana is a heavy importer of fertilizer, as opposed to certain countries or our neighboring country like Nigeria that exports a lot of fertilizer. But looking at the downside risk alone without looking at the bright spots, I'm not sure it's a very good balance. So let's also look at what are the bright spots that we can gain out of this. For the bright spots, you'll be looking at two major channels through which Ghana can benefit out of this crisis. So of course, if you recall, we mentioned earlier in our presentation that gold accounts for almost a 2/3 of Ghana's exports. So this means that increases in price of gold, which of course is backed by uncertainties in the global economy, volatilities in the market, is going to prop up gold prices. And Ghana is set to benefit from this because there are only two ways we can benefit from gold, which is prices and then output volume. You've seen some form of rise in output volumes in 2025 we did an export of about 6 million tons of gold with an output or an outlook of about 6.5 million for 2026. So we have that expectation that gold output will increase, and then we also see that prices are also on the rise. So we think this is one of the bright spots that Ghana can potentially benefit from, with its potential impact on our exchange rate and then our macroeconomic stability. However, there is a caveat. Ghana's overexposure of gold exports to the Middle East, especially with 72% of our artisanal mining gold going to Dubai, is a major concern. This means that any disruption to Gulf logistics, talk about transport of bullion, aviation, could have a serious impact on exports, and this can derail the benefits that we will get from our gold export. Another side of the bright spot that we would like to look at is oil prices. So just as Jimmy mentioned, Ghana is a producer of oil, and that means that higher hydrocarbon prices provides a serious key upside for Ghana. However, with this also there's a caveat. In the past 6-7 years, we've noticed decline in our production levels following years of underinvestment in the upstream sector. Ghana's oil production peaked at 71.4 million barrels. That is for the annual in 2019, and has since decreased to 48.2 million barrels in 2024. So we see a very consecutive and sustained decrease in oil output. This means that we might not benefit as much from this higher oil prices than if we had better levels of oil production. Now, finally, the question is, we've looked at all this risk, but we asked the question, how can Ghana hedge against this risk? What can we do to insulate ourselves from the negative effects of this? And then we prefer two solutions or two recommendations. The first is diversifying our gold export market. Just as we mentioned that we have an overexposure to one market, this comes with its own risk. So we believe that diversifying our markets, our gold markets, can help us to mitigate some of this risk, as heavy reliance on a single export corridor, increases vulnerability to flight disruptions, delays in bullion transport, and also its attendant impact, just as it was mentioned, such as higher insurance costs that will now be associated with the Middle East. And then also, another area of concern is our oil production. It's about time we increase or beef up investment in the upstream sector so that our oil production can increase. Another section is, in the webinar or the discussions that we had, we realized that most of our refined petroleum products are imported. We believe that expanding domestic refining capacity can help us reduce dependence on imported products, refined products, to cushion the economy from external supply shock. And for this, recently we heard that the Tema oil refinery, which is, I believe, one of the biggest in Ghana, resumed operations in 2025 after almost 6 years of inactivity. And we believe this is a step in the right direction and will help us to hedge against some of these risks. So overall, we believe that some of these things, when they are done, Ghana can successfully hedge against the macro risk that is coming from the Middle East. I will end the presentation over here so that we can zoom into the Q&A session. If you have any questions and answer, if you have any questions, we will address your questions in this session. I'll be handing over to my colleague Cornelius to take the session. Cornelius, over to you.
All right, thank you very much. All right, thank you very much, Mr. Prince. And also, thank you very much, Mr. Jimmy, for this wonderful presentation. Mr. Prince is our analyst, and Mr. Jimmy is our head of consulting. All right, thank you very much, Mr. Prince, for this wonderful presentation, and also Mr. Jimmy for this insightful presentation. Mr. Jimmy is our head of consulting, and Mr. Prince is our analyst. So we are going to take our second poll. The poll will pop up on your screen very soon. Yes, so the poll says, what is the most likely trajectory for the Ghana cedi if the Middle East tensions persist? So we are going to take 30 seconds for this. So let's try and also participate and answer this one. Very interesting. So from here, we'll take the results of our first poll and also the results of our second poll, and then we'll dive into the Q&A session. So just 30 seconds for this one. What is the most likely trajectory for the Ghana cedi if the Middle East tensions persist? Just 5 seconds more. All right, that's fine. So let's take the results of our first poll. It will be popping up on our screen very soon. Right, we will dive into the Q&A session. You can drop all your questions at the chat area, or you can put it in the Q&A box. And once we take the results of the first poll, and then the second poll will now dive into the Q&A session. So the results of the first poll, if it's ready. Wonderful. So the first poll reads, which area of Ghana's economy is most vulnerable to a prolonged Middle East conflict? So about 53% of us are saying that fuel imports build and then pump prices. That's wonderful. 40% are looking at the inflation and the cost of living. And then I think 7% of us thinks is the fiscal and performance and subsidies. So let's take the result of the second poll, please, if it's ready. It's very, very wonderful, very interesting. Very, very interesting. So the results of the second poll. Yes. So for the second poll, it reads, what is the most likely trajectory for the Ghana cedi if the Middle East tensions persist? 70% of us says that it remains broadly stable due to gold inflows and reserves. That's wonderful. 25% are saying experiences mild depreciation pressures. Okay. 42%, which is the majority, thinks that the cedi is going to face heightened volatility despite interventions. And then 70% are considering that it comes under severe sustained pressure. Okay, that's very interesting. That's wonderful. That's wonderful. So now we'll zoom into the Q&A session. If you have any questions.
Cornelius, I think we had received a question or two before the session, and I think the poll actually helps with the question we had received. Can we bring up the first poll again? Is it possible? So let's bring up the results of the first poll. Then we'll also talk about the results of the second poll. Okay. I think this is actually quite interesting because in the build up to this session, there had been questions around the possible impact of Dangote refinery on fuel import prices in Ghana amidst all of these issues. You know, Dangote has built Africa's biggest refineries, one of the biggest refineries in the world as well. Over half of everyone in this webinar says that we think that Ghana's biggest vulnerability will be around the fuel import bill and pump prices, which is quite true. So the question then, if we have to align this risk factor we've all raised with that question around possible impact of Dangote refinery, possible impact being, will there be upsides? It's coming from Nigeria, which is 2 countries in between, and you know, maybe half a day or a full day's journey, depending on the mode of transport. So shouldn't that have some possible upside impact on Ghana? Permit me to start with a joke. So the first question will be, what has Dangote refineries in Nigeria itself? Okay, and I think we can begin to then say, what impact will it have on Ghana using Nigeria as a benchmark and as a, you know, marker, if I have to use that military parade term. So first, Ghana went ahead of Nigeria with this whole subsidy arrangement. I know we have a modulated pricing arrangement in Ghana. However, even the modulated pricing arrangement doesn't have a subsidy wrap on it. That's first. Dangote Refinery will sell refined petrol to Ghana like it will sell to the rest of the world at a price that has gone through a price discovery process. And it will sell that refined petroleum to Ghana at a price that helps it recover costs and with margins. Will there be lower transport costs? Relatively debatable. While the distance between Nigeria and Ghana is shorter than from Asia or the Middle East, because the transportation networks, either by road, by sea, and there are no rails, because the transportation networks are not so mature, that price saving that we think we will get coming from Nigeria to Ghana will not be significant enough to create a dent in the price of petrol in Ghana. So the sad news here is that your fears are real. The fuel import bill and the pump prices that 53% of you have highlighted is a real fear. And then when you look at the fact that when we're talking of cost of living, so even 40% have said cost of living, but you can then put these together, 53% for fuel import bill and pump prices, 40% for cost of living, cumulatively that's 93%. One major factor that determines the cost of living in Ghana, one major factor that determines inflation in Ghana is the pump price of petrol. Transportation, because as a country, transportation is largely road-based, and road transportation in Ghana is petrol and diesel driven. So if those who have said our biggest fear is inflation and cost of living, and those who have said our biggest fear is fuel import and pump prices, you're more or less in the same WhatsApp group, you're more or less in the same room, and those fears are genuine. And while the Dangote refinery may help with supply security, it will not, our outlook today is that it will not create a major dent on pricing. So there are questions in the chat room. We can begin to take those questions now. But I just thought to address the first poll. And if we've got more time, I think there are other issues on the second poll that we would like to also challenge. We would like to challenge the views we've seen in the second poll. But Cornelius, I think we can take the questions in the Q&A room now.
All right, thank you very much, Mr. Jimmy, for that insightful dive into the first poll. So for the first question, it's from David Lai, and he's saying that despite 𝗀 resuming its operations, its production cannot supply the entire country, that is Ghana. Are there other upcoming refinery operations coming up. Without these new refineries, the bulk distribution country would have to rely on imports. I think this question is directly related to Ghana, so it will go, Prince, I'll hand over to you.
Yes, so thank you. Thank you, Cornelius, for that answer. I believe that this conversation, we should rather be looking at production of oil rather than refinery of oil. Because one thing a refinery does is to do what? Put the oil in the final consumption format for consumption to be sent to the market. So I believe that the conversation is not about having an extra refinery or two working, but increasing our oil production. This way, even 𝗏 can have enough feedstock to work with. And I believe if we should increase our oil production, this can positively impact so that if we have enough, that, okay, now 𝗏 is working at a very reasonable capacity, using a very reasonable percentage of their capacity, then we can have that conversation about having extra refineries coming into the conversation. Thank you.
Maybe me to just weigh in with a word or two. Even when the 𝗘𝗰 refinery, if it becomes optimal today, even though we have very radical views on the 𝗘𝗰 refinery, but even if it becomes optimal, let's remember that crude oil is a global commodity and it's priced in dollars. And what you've seen, for instance, in Dangote refinery is where that pricing has been Naira denominated, the local currency. However, even if you take those kinds of templates and adopt on the 𝗘𝗰 refinery, and like Prince has said, production is important, but very importantly, pricing benchmarks will remain in dollars, even if the pricing will be benchmarked on the dollar to the CD, but it would still be priced along with global pricing. If not, anything outside that arrangement would mean a subsidy, which would then create a dent on our fiscals. So it's really a hard balance. We're caught between a rock and a hard place. First, having more refineries, bringing up 𝗘𝗏. These are hypothetical suggestions, but quite valid as well, but they're hypothetical. But even in that hypothetical scenario, what we need to recognize is that it would basically save us on transport. That's what it would basically save us on, transport of this crude oil from 𝗘𝗏 to the rest of the country. But overall, it would then be priced in US dollar, because if we sell at a cheaper rate outside what we can get from the global markets, it means that opportunity cost, we have to define it as a subsidy. And we can take Julius 𝗀𝗀 question as well. Cornelius.
Right. Mr. Julius 𝗀𝗀 also has a question. And he's asking, please, considering that gold is exported through the airlines, and not the Strait of Hormuz, do you still think gold exports will be impacted negatively? This also has to do with the economy of Ghana. So, Prince, I'll hand over to you.
All right, so thank you, Cornelius. I'll attempt this question, and then I'll also hand over to Jimmy to input his comments as well. So, of course, gold is exported primarily via airlines or aviation. But recently, we all heard when this crisis started, we also, the closure of airspace in the UAE. And this was what ignited the conversations around our exposure once again to the Middle East. So it's not only about the Strait of Hormuz, because of course, even when we are talking about airlines, it's about the contagion of risk around the whole region. So we are not looking at only Hormuz. Of course, most of the world's oil and then very important product passes through the strait. But we are looking at the risk that the region as a whole has on some of these commodities. I don't know if Mr. Jimmy would like to take a shot at this as well.
Okay, so very quickly with it, I think the important thing here is, and when you were talking about how Ghana can hedge from all of this, I think the important thing is how we can begin to diversify in terms of gold exports from the UAE as a country. Because first we have to even follow, if we take things from the top, we have to follow the trajectory of this crisis. If this crisis worsens and global economy tightens as a result of this, the emphasis then becomes gold becomes a safe asset, because that's the role of gold in asset classes. So gold becomes a safer asset, which means that we could possibly see price spikes, which would help Ghana. But to counter that upside, there's a downside, which is the dependence on the UAE as a major export for Ghana. So what we need to do now is to begin to diversify in terms of our supplies away from the Middle East to places like India, which is a high gold purchasing country, and to the rest of Asia as well. Thank you very much.
Right, that's very wonderful and very insightful. I think we have some 5 minutes for any additional question. So if you have any additional question, you can drop it and we'll take it. In the event of no other question, I'll hand over to our country manager, Wonu Bello, to Wonu, over to you.
All right, thank you very much, everyone, for your time this morning. It really has been an insightful session. Thank you to our speakers, Jimmy and Prince. If you do have questions outside of this webinar, please feel free to send us an email or contact us via telephone. We're always open to answering these questions after or to engage in meaningful discussions. Before we wrap up, I would just like to tell you a little bit about Agusto & Co. Agusto & Co. is a Pan-African rating agency licensed by the CMA in Kenya and Rwanda and by the Securities and Exchange Commission of Nigeria and Ghana. Agusto & Co. pioneered the ratings market in Nigeria and has been in existence for over 32 years. Agusto Consulting, who we've worked with as a partner in bringing this presentation, is a subsidiary of Agusto & Co. And the Agusto Consulting provides different consulting services, including advisory, economic advisory, strategy sessions, people and management. So if you and through these products and offerings, we're able to provide impactful insights and meaningful discussions that guide organizations to create value for their shareholders. Thank you very much for your time today. It's been a pleasure having you. I think we'll end the session here. So thank you, everyone.
Bye-bye, everyone. Thank you.